If you are 65 or older, please stop what you are doing right now and listen carefully, because what I am about to tell you could either save you thousands of dollars or cost you everything you were promised this year. Imagine this. You are sitting at your kitchen table. The morning sun is coming through the window. You hear the mail truck pull away. You walk outside, you bring in the mail, and there it is, a white envelope with those 3 letters on the corner, IRS. Your heart drops. You open it slowly, and the letter says you owe back taxes, plus a 20% penalty, plus interest, all because of one small box you checked, or didn't check, on your tax return this year. You did nothing wrong on purpose. You were just trying to claim the new $6,000 senior deduction that everyone has been talking about on the news. You heard the president signed it. You heard Social Security is tax-free now. You heard you would get $6,000 off your taxes. But here is the painful truth. Most of what you heard is wrong, and the IRS is already sending out correction notices to seniors across America. Hello, my friend. I am June. I am a Senior Policy Analyst, and I have spent years helping retirees like you understand the complicated tax rules that Washington keeps changing on us. And today, on Retirement Tax and Law Pro, I am going to walk you through, step by step, exactly how the new $6,000 senior deduction works. I will tell you who qualifies. I will tell you how much money you can actually keep. And I will warn you about the 4 traps that the IRS is using right now to deny this deduction to seniors who think they did everything right. And please, I am asking you, stay with me until the end of this video, because there is one hidden mistake, number 5 on my list, that I have seen cost seniors their entire deduction and trigger a 20% IRS penalty on top of it. Most tax preparers are not even warning their clients about it. So pour yourself a cup of coffee, sit back, and let me explain this the way I would explain it to my own mother. Part 1. The story of Robert. Let me tell you about Robert. Robert is 67 years old. He lives in a small town in Ohio. He worked for 38 years at the same manufacturing plant. He retired 3 years ago. His wife Linda is 64. She will turn 65 next March. Robert is the kind of man who does things the right way. He pays his bills on time. He files his taxes early. He even keeps a paper folder in his filing cabinet labeled Taxes, with every receipt from the last 10 years. In January of 2026, Robert sat down to file his 2025 tax return. He had heard about the new $6,000 senior deduction. He was excited. He thought to himself, Linda and I will get $12,000 off our taxes this year. So Robert did what he always does. He went to the tax software. He typed in his numbers. And then he made a small decision that cost him dearly. Robert and Linda usually file jointly. But that year, Linda had some medical bills she wanted to deduct on her own return. So Robert thought, let's file married filing separately this year. We will both still claim the $6,000 senior deduction. That's $12,000 total. Perfect. 8 months later, Robert got a letter, a CP 2000 notice from the IRS. His $6,000 deduction was denied. Linda's was denied too. They owed back taxes, they owed interest. And the IRS added a 20% accuracy-related penalty under Internal Revenue Code Section 6662. Robert called me in tears. He said, June, I followed the rules. I am 67 years old. Linda is 65. We have the Social Security numbers. We are American citizens. Why did they take it away from us? And here is what I told Robert and what I need to tell you right now. The new $6,000 deduction has rules, specific rules, written rules. And one of them, one that almost nobody is talking about, is that you cannot claim this deduction if you file married filing separately. The IRS rule is crystal clear. You must file jointly, period. Robert made one small choice, and it cost him over $2,000 in taxes and penalties. Now, I do not want this to happen to you, so let's slow down. Let's go through this rule together, the right way. Part 2, what the law actually says. Let me explain this in plain English, the way I would explain it to a friend over a kitchen table. On July 4th, 2025, the president signed a new law called the One Big Beautiful Bill Act. Inside that law was a brand new tax break for older Americans. The IRS officially named it the Enhanced Deduction for Seniors. Here's what it does. If you are 65 years old or older by the end of the tax year, you may be able to deduct an extra $6,000 from your taxable income. That is on top of your regular standard deduction, and on top of the extra standard deduction seniors already get. For a single senior filer in 2025, that means your total deduction could be up to $23,750. For a married couple where both spouses are 65 or older, you could deduct up to $46,700. That is real money. That could mean $700 to over $1,300 back in your pocket, depending on your tax bracket. But, and this is important, there are conditions. Condition number 1. You must be at least 65 years old by the end of the tax year, not turning 65 next year, not 64 and a half, 65, by December 31st. Condition number 2, you must have a valid Social Security number on your return. If you only have an ITIN, you do not qualify. Condition number 3, if you are married, you must file jointly. Remember, Robert? This is where he tripped. Condition number 4, your income matters. This is where most seniors get confused. Let me explain. The full $6,000 deduction is only available if your modified adjusted gross income, what the IRS calls MAGI, is below a certain level. For single filers, the phase-out begins at $75,000. For married couples filing jointly, the phase-out begins at $150,000. After that, the deduction is reduced by 6 cents for every $1 you earn over the threshold. And once your income hits $175,000 as a single filer or $250,000 as a couple, the deduction is gone, completely. Let me give you a quick example so this is clear. Suppose you are single. Your MAGI is $100,000. That is $25,000 over the threshold. 6% of $25,000 is $1,500. So your deduction is reduced from $6,000 to $4,500. Still a great deduction, but not the full amount. Now here is one more thing you need to know. This deduction is not permanent. It is in effect for tax years 2025, 2026, 2027, and 2028. That is it. After 2028, unless Congress votes to extend it, it is gone. So you have 4 years, 4 tax returns. Do not waste a single one. Part 3, the biggest lie you have been told. Now, my friend, I need to talk to you about the biggest lie circulating about this new law. You may have heard people say, Social Security is now tax-free. You may have even gotten an email from the Social Security Administration itself back in July of 2025 that said something like that. Stop, listen to me carefully. That email was wrong. The Social Security Administration issued a corrected statement later admitting they had misrepresented the law. The one big beautiful Bill Act did not eliminate taxes on Social Security benefits. The old rules still apply. If your provisional income is over $25,000 as a single filer or $32,000 as a couple, then a portion of your Social Security benefits is still taxable, just like before. Now here's the good news. Because the new $6,000 deduction lowers your taxable income, it can indirectly reduce the amount of Social Security benefits you pay tax on. For some seniors, it may push your income below the threshold entirely. But please, and I am begging you here, do not stop withholding taxes from your Social Security check thinking it is now tax-free. If you do, you may face an estimated tax underpayment penalty under Internal Revenue Code Section 6654 when you file next April. I have already seen retirees fall into this trap. Do not be one of them. Part 4. The 5 big mistakes seniors are making right now. Let me walk you through the 5 most common mistakes I am seeing seniors make with this deduction right now. Write these down if you can. Mistake number 1, assuming everyone over 65 gets the full $6,000. They do not. If your income is too high, the deduction shrinks. And if your income is very high, it disappears altogether. So before you celebrate, check your MAGI. Mistake number 2, thinking it replaces the existing senior standard deduction. It does not. The new $6,000 deduction is added on top of your regular standard deduction, and on top of the extra $1,500 to $2,000 that seniors already get. It stacks. It is a layer cake of tax savings. Do not let any tax preparer tell you otherwise. Mistake number 3, believing it covers retirees under 65. It does not. According to AARP, more than 13 million Social Security recipients are under 65. That includes people who took early retirement at 62, 63, or 64. It includes most people on Social Security disability. None of them qualify for this deduction. You must be 65 or older by the last day of the tax year. Mistake number 4, married filing separately. This is Robert's mistake. If you are married and you want this deduction, you must file jointly. If you file separately, you lose the entire deduction. Both of you, no exceptions. And now, here is mistake number 5, the one I promised you at the beginning, the one almost nobody is talking about. Part 5, the hidden mistake that triggers a 20% IRS penalty. Mistake number 5, claiming the full $6,000 when you do not qualify for the full amount. This is the trap that the IRS is using to catch seniors right now. Here is what is happening. Tax software is asking you, are you 65 or older? You check yes. The software automatically puts in the full $6,000 deduction. But the software does not always check your income. It does not always run the phase-out calculation correctly. And so seniors are filing returns claiming $6,000 when their actual allowed deduction might be $3,000 or $1,500 or $0. When the IRS matches your income to your return, they will see the overclaim, and they will send you a CP 2000 notice. They will demand back taxes. They will charge interest. And under Internal Revenue Code Section 6662, they can hit you with a 20% accuracy-related penalty on the underpayment. This is happening right now to real seniors in every state. So please, if you are over the $75,000 threshold as a single filer or the $150,000 threshold as a couple, do the math carefully or get help from someone who knows how. Part 6, 3 exact actions you must take now. Let's talk about what you actually need to do. 3 steps. Simple, clear. Do them this week. Step 1. Use Form 1040-SR. Not just Form 1040. The IRS created Form 1040-SR specifically for seniors 65 and older. It has larger print, it has a built-in standard deduction chart, and it makes it easier to check the age 65 box correctly. This is the form the IRS designed for you. Use it. Step 2. Verify your eligibility using the official IRS tools, not random websites. Go to IRS.gov. Search for publication 554, the official tax guide for seniors. It explains everything we just talked about in writing from the IRS itself. There is also a free tool called the Interactive Tax Assistant, also on IRS.gov, that helps you figure out exactly how much of your Social Security is taxable and how the new deduction affects you. Step 3. Get free certified help from the IRS itself. If you are unsure, and most seniors are, do not go to a random tax shop in a strip mall. The IRS runs 2 free programs for seniors. They are called VITA, which stands for Volunteer Income Tax Assistance, and TCE, which stands for Tax Counseling for the Elderly. The volunteers are IRS certified. They know this new deduction, and the help is 100% free. You can find a location near you by going to IRS.gov and searching for VITA TCE Locator. And one bonus tip, if you already filed your 2025 tax return and you forgot to claim this deduction, you have up to 3 years to fix it. You can file an amended return using Form 1040-X. Do not leave money on the table. Part 7, the final warning. My friend, before I let you go today, I need you to hear me clearly. This deduction expires after the 2028 tax year. That gives you 4 tax returns to take advantage of it. 4 chances. After that, unless Congress acts, it is gone forever. A single senior who fails to claim this deduction can lose up to $1,300 per year. A married couple can lose up to $2,600 per year. Over 4 years, that is more than $10,000 of your hard-earned retirement money. Money that is yours. Money that the law says you are entitled to, but only if you claim it correctly. And please, please do not rely only on YouTube notifications or social media posts or what your neighbor told you at the grocery store. Tax laws change. Income thresholds shift. The Social Security Administration itself sent out a wrong email in 2025. Even government agencies make mistakes. You must verify your information directly from official sources. IRS.gov, SSA.gov, Medicare.gov, AARP.org. These are the only places that will give you the truth. If this video helped you understand the new senior deduction, please give it a thumbs up. It tells YouTube to show this video to other seniors who need it. Subscribe to Retirement Tax and Law Pro so I can keep bringing you these updates every week. And in the comments below, tell me, do you think Congress should make this deduction permanent or let it expire in 2028? I read every single comment. And one more thing, share this video with someone you love, a parent, a grandparent, a friend at church, because somewhere out there, right now, a senior, just like Robert, is about to make a $6,000 mistake on their tax return, and you have the power to stop them. I am June, this is Retirement Tax and Law Pro, and I will see you in the next video. Take care of yourself, and take care of your money.